Thanks for tuning into BQ Conversations. I'm your host, Neeraj Shah. Every time that you think about investing, it's always good to think about when you're thinking about companies, thinking about the profit pool of the industry and what the company could do within. Or when you're thinking about investing in an asset class, think about the opportunity size that exists, the kind of money that is likely to come in or existing out there, and then trying to hypothesize about what quantum of money could come or follow that particular asset class. And that's what we are trying to do today in this slightly different conversation that we do than what we do normally. Our guest today on this show is Arvind Chari, CIO Q India UK. He joins us from London, and Arvind of course has a rich experience of India by virtue of being one of the premier voices on the fixed income side in the country, and then has shifted roles, and would love to understand from him how he thinks about what's happening around the world, what's the kind of money that would come into different kind of risk assets, and then talk about India. Arvind, great having you. Thanks for taking the time out.
Thank you so much, Neeraj. Thanks for having me.
No, the pleasure is ours. So Arvind, let's talk about this. There's, of course, a lot of talk about what the QT, QE, Fed tightening, Fed easing would do to money flow, how much of it would come into risk assets as things stand as we finish the first half of the current calendar. What is your view?
So I think if you look at the last 2-3 months, we are seeing some foreign equity flows. I'm talking about equity markets, right? Foreign portfolio flows. We don't know the complete breakdown, but it looks like it is two parts. One is passive India ETF kind of allocations, and could also be a lot of reallocations by global emerging market funds. And if you look at the last 21 and 22, global emerging markets funds who have an India allocation, they've been net sellers, right? I think cumulatively they must have sold about $25-30 billion of Indian equities, and it kind of got amplified late last year when there was again this surge of getting money back into China, right? Where China was again whatever reinvestable, or you could look at China again, and of course valuations are very cheap, so you saw even more outflows from India. But I think that thing seems to have got pricked. That if you remember the balloon that went into the US, I think that seems to have pricked that flow into China momentum, and maybe you're seeing some of those allocations coming back. So that is more reason. Maybe you will see more of it because there's been so much outflows out of India from global emerging market funds. And just in the general point, right? Global investors seem to be so underallocated, and we'll talk about that in detail. That is where the opportunity lies in terms of size. But right now, I think given if you started with QE and QT, I think India seems to have managed the macro pretty well, given the fact that oil prices have remained below the $100 mark, and the fact that Indian inflation and Indian interest rates are where we are in normal terms. Right? If you look at a 20-year average of Indian inflation and a 20-year average of Indian interest rates, we are at that level as compared to the developed world, which is facing a very different challenge, right? So Indian policymakers, Indian government, Indian central bank, Indian companies, and Indian individuals know how to operate in this level of inflation and this level of interest rates, which is a fairly normal cycle. So, excessive tightening in the US and higher interest rates, which seems very likely that, global interest rates will be headed higher, will take away some near-term tactical flows. But I think India is reasonably well placed from that perspective, from a macro allocation risk perspective.
Arvind, earlier this year in Davos, the view of both companies and money managers was that, of course there are alternatives, but that that one cannot miss India. Now we've seen signs of corporates investing into India, the poster boy being the Apple investment, but a clutch of Japanese and others also coming in. And as you rightly said, starting April, we've seen money flows coming into is as well. The rate at which block deals are getting subscribed to is just insane. So my question is, when you think about money that comes into EMs at large, what is your view there? And then I would love to understand from you about individual investments into different nations, and how soon can India get to a prominent size there, according to you?
Sure. I generally get a bit wary when there is just too much hype. Right? You will remember BRIC. India was part of BRIC, and it got us so much hot money and money which had unrealistic expectations, and that unrealistic expectation was just one. It's very simple: GDP growth. Right? India was expected to grow at that 8-9%, become the next China, and so much amount of money came with that expectation. And then what a lot of the money that came between 2007 and 12 would have typically lost money, right? I mean, lot of either would have been very low single digit kind of returns below US treasuries as a benchmark for foreign investors, or some of them would have just purely lost capital in infrastructure and real estate. And I was at a conference in 2012, and a large investor, we were talking about India allocation. A large investor said, India, I will never do it again, right? That was the experience that people had, and I think it just came out of unrealistic expectations on growth and on returns and on the size of the market, right? So you should always be wary of when things get out of hand, or things get too hyped up. You will tend to get investments with wrong assumptions, and typically those will be suboptimal decisions, and then that in those investors' return and their experience will be very, very different from what a normal investor in India has experienced and should experience. And I'll talk about that in detail. But since you asked me about allocation, of course there is so much money that can come into India today. If you look at the global pool of money, when we call about assets under management, it's about $300 trillion. Pension funds, sovereign wealth funds, insurance companies, university endowments, and all the rich, the high net worth individuals, right? And their money is typically either in a mutual fund or in a private bank or in a wealth management, but they're all allocated money, right? And if you look at the amount of money that we have received till now, it's very difficult to get market values on private equity and venture, but I would put it around, say, $1.5 trillion. And I'll break it up like that. Like if you look at the public equities, foreign portfolio investment in public equities, it's about $600 billion. $200 billion in cost, and about in market value terms about $600 billion. This is over the last 20 years. Fixed income is about 50, 60 odd. And private equity, venture, infrastructure, real estate has got about $450 billion of cumulative flows. And that market value is difficult to determine, but let's say 2x, so right, about say 800. So that is the amount of money. So if you look at 300 trillion and $1.5 trillion, it's less than close to 0.5% or less than, very much less than 1%. And that is important, right? Because India's share in the global GDP is already 3%, right? That share will increase to 5%, 7%, maybe even beyond 10% over a period of time, right? And that's when global investors look to allocate, they will look for opportunity, and they will look for size of the market. They will look for the absorptive potential. And India has that and has that now and will increase. So from that perspective, global investors seem underallocated, right? Even if you say that, okay, half of their allocation is home country, developed markets, and then the half is what we call emerging markets, right? That's still less than 1%. It's still less than India's share of global GDP. And then, if from an opportunity perspective, if you just pull out, India was a very large part of global GDP, right? If you go to 1500, 1600, India was, upwards of 10% of global GDP. And think of all the trade and investment that India had with the Middle Eastern world and the Western world then. Something similar is likely to happen, right? And that's the way to think about, just in terms of, do you want to participate in that opportunity? And if so, how do you do it? But right now, the way the investment world works, especially in the public equity markets, many are still not allocated to EM. Forget about India. So, the first step for them is to do non-developed markets and emerging markets. Many have EM allocations. But emerging markets as a basket of allocation has not worked at all points. It's not a very long term. Like if you look at 20-year returns of emerging markets in dollar terms, it's performed every asset class. Like and then in emerging market, you have China, which is whatever 35-40% of the weight in the index. And it gets difficult for you to make that kind of allocations, right? So typically, India has been played through emerging markets. Like the way to think about that is, if you look at that $600 billion in portfolio flows in India, about 400 billion of those is from global emerging markets or global funds and their allocations to India, right? And India dedicated public equity funds, which is either ETF or active managers like us. It's less than $50 billion, right? So it's not a big market. But that should change, right? Right now, people are still thinking about allocating to India through EM or through Asia. Recently, we've seen RFPs, as they call it, for Asia ex China, which means they're still not taking a dedicated India view, but they either they don't want to invest in China, or they want to do China separately, China dedicated. So they're doing Asia ex China, and it's still not India. And that is where the dedicated mandate scenario is in terms of how investors think about India dedicated. Some of them have already done it. Some of them have done it more in the private markets. So you can see a lot more India dedicated money in private equity, venture, infrastructure, and real estate. Yeah, that like the Canadian pensions, or the Middle Eastern pensions, or even GIC, they will have a lot more, I think, India dedicated allocation to private equity, venture, infra, real estate, as compared to public equity. The names that I used, they also have India dedicated public equity, but that pool is a lot lesser. They're still thinking of allocations through emerging market funds or through Asia allocations as compared to dedicated India. But that's where the opportunity is, right? Like as I said, if India is going to be a large part of global GDP, and in India, one thing is very true, that Indian companies are very good in converting macro global GDP economic opportunity into revenues and profits, which gets reflected in the markets, which has not been true in China at all, right? So China GDP is like this, and stock markets are done here, whereas Indian GDP and Indian stock markets are actually very closely linked.
True.
So if you want to take that opportunity, then most of my talk to global institutional investors is to think about India as a dedicated approach. And then what that means, should you have 2%, 3% weight in India over a period of time? And if you do that, then what does that mean for your investment, your risk, your approach to, what asset classes you want to do? What manager relations do you need to maintain in India? Do you need to have a direct approach? All those kinds of discussions, I and many other investors must be having with dedicated investment. And I think as we saw dedicated mandates in Japan, in Korea, in China over the last 10, 20, 30 years, I think India will see a lot more of that as well.
When you talk about this with the current crop of people that you must be meeting, Arvind, does the question of depth in the market come to the fore? And part two of my question, does the recency of the second half of 2022 get viewed positively in that they got seriously good exits without too much of damage on the ticker?
Absorptive capacity is always a issue, right? A lot of people will look at index valuation and say India is expensive. Of course, India is expensive on a when you see absolute terms, even relative terms. So that will always be a challenge. But India has always been expensive from a relative perspective, right? But absorptive capacity will also change, right? Look at the number of, like, just in public equity, look at the number of private equity and venture funded entities which will exit. We've already seen some.
Yes.
The experience hasn't been great, but you will see a lot more, right? Because private equity, venture capital funds have 7-year, 10-year cycles, and somewhere they need exits. And not all exits are going to be secondary or strategic. It will have to come in the public market. So absorptive capacity always keeps in pace with the change in the economy, and that will grow. So no one is saying foreign investors should have a 10% allocation to India today, right? They will build their allocation over a period of time, right? And as they build and as they invest and as domestic investors invest, the absorptive capacity obviously always increases. If valuations remain attractive, many more promoters, founders, PE, VC investors will want to exit and will want to take an exit. So I think capacity will increase. Maybe right now we see that there's just suddenly flows come and valuations go haywire. But that is kind of a short-term cyclical problem. But as the economy grows, you will see absorptive capacity, and it's across asset classes, right? Fixed income has literally next to nothing in India, right? From global investors.
Yeah.
They will do a lot more of infrastructure, real estate, as well as the policy making and the regulations and the contracting, and has gotten better in those areas. So when they do so if some pension has a 3-4% weight in India, for example, it's not going to be only in public equity. It will be across asset classes, and there is absorptive capacity everywhere. The thing to worry about is, we can talk about it in terms of what is opportunity and what is the risk, right? That is what they will need to weigh. But the fact that they need to be allocated is very much there, and people recognize it. It's just that they have to take that leap of faith in terms of having dedicated India allocations as compared to doing India through other sources.
Let's hope it happens soon. In which case, the last couple of things, and the first thing, let it be this: what are the opportunities? What are the risks?
I think the India story is very, very, very simple, right? You don't need to make it complicated at all. I told you about the long-term GDP in terms of what India was at the global share of GDP, and it is likely to play out over the next 10, 15, 20, 30 years. Just look at the last 40 years, right? Since the time we started reforming, 1980s, and then 1990 when we were pushed to the shove, and then we actually reformed. And what has successive governments done in that 40-year period? I would say three things. Opened up the markets to market economy, market pricing, let private competition decide who does business, which products get sold, what is the competition, right? Second is to enable that liberalism, right? Allow more private players, allow more foreign players. Like today, I think almost 90% of India's FDI is what they call automatic route, right? Some figure like that, where you're allowing foreign investors and domestic investors in a liberalized, regulated manner, and to enable both the markets to function and to private competition to succeed, you need a rule of law, right? You need a set of regulators, independent regulators, and we have that, right? So RBI, SEBI, the different regulators across different sectors, the Ministry of Finance as an overseeing, and other ministries. So this is the framework that we use. This is very different from, say, China or from, say, Russia or Turkey, where foreign investors have invested dedicated amounts of money there, right? It's very different in India in terms of this, and this has been true across governments, right? It doesn't matter left government, right government, single party coalition. Mostly we've seen this three aspects of reform is what has played out over the last year. And I think it will continue. It will continue for the next 10, 15, 20 years. And what that has resulted is the fact that India has consistently grown on an average basis at between 6 and 6.5% in real GDP terms. And nominal GDP is about 11 to 13%. We've seen that over the last 30, 40 years. I think we will see that over the next 10, 15, 20 years. And so when nominal GDP grows at double digits, as I said before, that, in India, companies have been pretty good in converting macro growth into revenues and profitability. And that's a very simple story that we've heard every time, right? That this, because of the macro growth, and then good companies, good businesses, good managements, efficiency and productivity leads to slightly higher growth for corporates, listed as well as unlisted. And that is the story, right? If you look at INR returns, long period of time, it should be between 13 and 15%. If you look at dollar returns, remove 2 to 3% annual depreciation, and you get either high single digit or low double digit dollar returns. And this is what the Indian indices have done. Right? So if you're comfortable with just that kind of risk and return, that is for you to take. Of course, you need to time, you need to allocate, you need to either do directly or look at managers who can manage that risk of governance and liquidity. But this opportunity is there, and it has happened before, and it should prevail. And so that's a very simple way of seeing that you can do, say, large cap liquid public equity allocations, right, and get that high double digit or low single digit. And anything that you do above that is a risk, right? So this is opportunity, and then you risk. So you go below the cap in small cap, mid cap, that you add a layer of risk and a return, and you go further down the scalability and cap curve when you go to private equity and venture, right? Forget about infra. Real estate is a very different asset class, is a very different stream of cash flow. But this is the scalability, capitalization, and liquidity risks. So if you're comfortable and you want to seek that higher risk and return, then you will go down the cap curve and
Sure.
and into private. And this is how it is. It's as simple as that.
Okay.
And I think, of course, investors realize it. They recognize it. But can they do it in a dedicated, allocated fashion? They are doing that in private equity and venture. I think they will do that in public equity, because returns in public equity are that much more visible and has proven over a period of time based on what just the large cap indices have given. Forget about active managers who might add certain amount of alpha over a period of time. But in private equity, I'm not sure. If you get in a good cycle, if you get in a good period of time, you might actually get excess returns. But if you enter in a bad period of time, or your expectations are different, or just look at the amount of money that came into Indian private equity venture in the last 2-3 years. And you're seeing all kinds of governance risks, so many cases of companies having governance issues, private equity venture funded. And that's the problem, right? You just invested so quickly and you will make suboptimal decisions. So this is a way to think about long-term allocation. If you're happy with low, high
Sure.
double digit, high single digit, low double digit, you can just do public equity and be done. And it is still higher than what you would get in your developed market equities over a period of time, right? That's the way to think about it. And it's higher than your pension return threshold or your sovereign wealth fund return thresholds that you can think.
I mean, just running out of time, but one quick question, about 60 more seconds.
Yes.
Yes. What is the most common positive thing that you hear? Because this thing about starting valuations, etc., is now documented. Despite all of these, what is the most optimistic response that you get when you talk about investing into India with people who haven't invested into India as yet, maybe?
I think this just the fact that we show a long-term return chart, right? And we show it against China, and we show that chart of GDP growth resulting in equity returns, right? These things are, people know about it, but they're not thought about it through in terms of you can just be in Indian public equity over a long period of time and achieve these kind of dollar returns. And I think everybody hears and reads about India, and now I think over the last 3-4 years, you've seen an increase of that. You saw a big mania in 2007, 2008, that period. And maybe you're seeing that, but for right reasons. I think the Indian markets have evolved, regulations have evolved, the governance structures, regulators, everything has gotten better. Size has increased, absorptive capacity. The domestic investors previously, when foreigners used to buy, markets used to go up. When foreigners used to sell, markets used to go down. Today, you have a domestic pool of money, which is kind of normalizing the volatility that you would normally face, right? So you have that asset class as well, or that pool of money as well, to be able to get. Similarly, in private equity venture also, I think it's not that there is a better ecosystem today in terms of investing. So I think the people will read and understand more about the opportunities and the long-term opportunity that you have in India. And I think they will also realize that China is still a tactical play. I mean, it's very difficult for people to do strategic China now from a geopolitical or political perspective.
Sure.
Whereas in India, you can actually do a strategic investment across FDI, FPI, private equity venture. Any asset class you choose, you can actually make a long-term strategic allocation. And I think that's people are getting to recognize a lot more.
Cross fingers for the party to continue and good times to last. But Arvind, great insights. Thank you so much for taking the time out and speaking to us today.